Topic examines fixed income markets for corporate issuers and explains how corporations obtain financing through debt instruments. Corporate issuers rely on fixed income markets to fund operations, expansion projects, acquisitions, and working capital requirements. Compared with equity financing, debt financing allows firms to raise capital without diluting ownership, although it increases leverage and repayment obligations. Corporate debt markets include both short-term and long-term financing alternatives tailored to issuers' credit quality, liquidity needs, and strategic objectives. Analysts must understand these financing mechanisms because they directly influence corporate capital structure, cost of capital, credit risk, and the financial flexibility of business organizations operating in competitive markets. Short-term corporate financing instruments are primarily used to manage liquidity and working capital requirements. Commercial paper is a widely used unsecured promissory note issued by corporations with high credit quality. Because maturities are generally less than 270 days, commercial paper provides low-cost financing for short-term obligations such as payroll, inventory purchases, and receivables management. Companies with weaker credit ratings may instead rely on bank loans or secured borrowing arrangements. Short-term financing is attractive because it usually carries lower interest costs than long-term borrowing. However, issuers face refinancing risk because maturing obligations must frequently be rolled over, exposing firms to changing credit conditions and interest rate environments. Repurchase agreements, commonly called repos, are another important short-term financing mechanism in corporate and financial markets. In a repo transaction, one party sells securities while simultaneously agreeing to repurchase them at a later date for a higher price. Economically, repos function as secured loans, with securities serving as collateral. Repos are widely used by banks, dealers, and corporations to obtain temporary funding and manage liquidity efficiently. Because collateral reduces lender risk, repo borrowing costs are typically lower than unsecured alternatives. Nevertheless, repos involve counterparty and collateral valuation risks, particularly during periods of market stress when collateral values may decline rapidly and liquidity conditions deteriorate significantly. Long-term corporate financing differs substantially between investment-grade and high-yield issuers. Investment-grade corporations generally have stable cash flows, stronger balance sheets, and higher credit ratings, enabling them to borrow at relatively low interest rates. These firms often issue unsecured bonds because investors perceive lower default risk. In contrast, high-yield issuers possess weaker credit profiles or elevated leverage and must offer higher coupon rates to attract investors. High-yield issuers frequently provide collateral or restrictive covenants to compensate for increased credit risk. The distinction between investment-grade and speculative debt significantly affects borrowing costs, market access, investor demand, and financial flexibility, making credit quality a central factor in corporate debt issuance decisions. Corporate bonds may be secured or unsecured depending on the issuer's creditworthiness and financing strategy. Secured bonds are backed by specific assets pledged as collateral, such as property, equipment, or receivables. In the event of default, bondholders have a legal claim on those assets. Unsecured bonds, often called debentures, rely solely on the issuer's general credit quality and cash flow generation ability. Because secured bonds provide additional investor protection, they generally carry lower yields than unsecured obligations of similar issuers. The choice between secured and unsecured financing reflects trade-offs between borrowing costs, operational flexibility, and the availability of collateral assets within the issuer's capital structure. Corporate issuers also employ a variety of bond structures to address investor preferences and market conditions. Fixed-rate bonds provide stable coupon payments throughout the life of the bond, while floating-rate notes adjust coupons based on market reference rates. Convertible bonds allow investors to exchange debt for equity shares, providing potential upside participation if the company performs well. Callable bonds permit issuers to redeem debt before maturity, often when interest rates decline. These structural variations influence risk, valuation, and investor demand. By selecting appropriate debt structures, corporations can optimize financing costs, manage interest rate exposure, and attract specific categories of investors with varying risk-return objectives and investment mandates. Credit ratings and investor perceptions strongly influence corporate bond pricing and market access. Rating agencies evaluate factors such as profitability, leverage, cash flow stability, liquidity, industry conditions, and management quality when assigning ratings. A downgrade in credit rating can increase borrowing costs and reduce investor demand, while an upgrade may lower financing expenses and improve market access. High-yield bonds often attract investors seeking enhanced returns but also carry greater default risk and price volatility. Consequently, credit analysis plays a critical role in corporate fixed income markets, helping investors assess the probability of default, recovery prospects, and compensation received through yield spreads over benchmark government securities. Topic ultimately demonstrates how corporate fixed income markets support business growth and capital allocation within the economy. Debt markets provide corporations with flexible financing alternatives across different maturities, structures, and risk levels. The interaction between issuers, investors, underwriters, and rating agencies creates an efficient mechanism for transferring capital from savers to productive enterprises. Corporate borrowing decisions affect leverage, profitability, and shareholder value, while investor demand influences pricing and market liquidity. Understanding the characteristics of corporate debt instruments and financing strategies is therefore essential for evaluating credit risk, analyzing corporate capital structures, and making informed investment decisions within global fixed income markets.